Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Wednesday, April 29th. First quarter real GDP dropped at a 6.1% annual rate, in part because inventory contraction sliced a whopping 2.8% off the change. Real final sales, excluding inventories, fell at a 3.4% annual rate. Inventories count, though, as the lower levels reflect sharply lower production. The bulls will grab onto the fact that real personal consumption expenditures rose at a stronger than expected 2.2% annual rate. In a typical business cycle, consumer spending picks up first, and this might be a signal of better times to come. Bears will note that the gain comes off horrible fourth quarter spending, and that January and February are light consumer months in which gains can be exaggerated by strong seasonal factors. Our opinion is that not too much should be read into the apparent consumer strength. Unemployment is going higher, wage gains are limited, and credit remains constrained. Separately, the business data and GDP were terrible. Investment in software and equipment fell at a 33.8% annual rate. Non-residential construction spending fell at an amazing 44.2% annual rate. Both of these categories will continue lower. Businesses remain in retrenchment mode even if the rate of decline might slow. Residential construction spending continued to plunge and was down at a 38% annual rate. Government spending fell at a 3.9% annual rate as state spending and defense spending contracted. This was another factor in the overall weaker GDP number compared to estimates. The analysis of the GDP data depends on whether the good consumer spending gain is seen as a leading indicator. That makes sense in normal cycles. This cycle is heavily dependent on government action and credit market conditions. Consumer spending could head down again in the second quarter, and risks remain high for the economy. I'm Pat O'Hare for Briefing.com. Thanks for listening.